Good afternoon and welcome to Hall Chadwick's 2021 Financial Reporting Update. My name is Graham Webb and I'm one of the audit partners here in the Sydney office of Hall Chadwick. Once again, I'm delighted to welcome Carmen Ridley from GAAP Consulting to present. Carmen is a former member of the AIASB and a technical resource used by our firm. As part of today's session, please use the Q&A box at the foot of your screens for any questions you wish to raise with Carmen. I'll ask Carmen either to answer these questions as she proceeds through her presentation or at the end of the particular section. Alternatively, if you'd like to speak directly with myself and Carmen, please click on the raise your hand button and you'll be taken off mute and be able to ask your question directly. On that note, I will hand over to Carmen to commence today's presentation.
Excellent. Thanks, Graham, and welcome everyone. As Graham mentioned, we would really strongly encourage questions throughout this session, so please feel free to type them in that box and hopefully we can answer them for you. So let's get started. We've got the next hour and a half or so to work through a few topics. And we thought when we were planning the session that we would give you a little bit of a flavour on some things that are new for 30 June 21. We'd also kind of cover a couple of other things that you might just need to be aware of, that they're not necessarily applicable for this year, but something that might help you with your planning. Then we're going to come back to the leasing standard. We did last year spend a fair bit of time talking about the leasing standard. We're really going to focus on what happens in year 2 in this session. So we kind of got there last year where we needed to be, but when we're looking at this year and we're seeing the changes that are occurring to leases, we just thought it would be really useful to work back through some of those modifications, the reassessments, CPI changes, etc., and how we deal with them. I'm going to spend a bit of time talking through the financial reporting framework and the changes that have happened. So in particular, the removal of certain for-profit entities to be able to prepare special purpose financial statements and what happens if you are currently doing RDR. We will then leave some time for Q&A. As said, more than happy to take the questions as we go through. So depending on the timing of the questions, if I've moved on from the topic, we'll address them in that Q&A session. Otherwise, we'll address them when I've finished talking about each of them. So let's look at the new standards for 30 June. Now, obviously, over the last few years, we have had a huge raft of fundamental new standards. We've had our financial instruments, our revenue, and our leasing standards. We are actually in a period of rest from the International Board. They always acknowledge that if they give us a huge lot of standards, they will then make life a little bit easier for us for the next year. And I thought I'd tell you that before I put up this slide that has 8 new accounting standards on there. Whilst it looks like there's a lot, I really don't think there's a huge impact for the vast majority of you who are listening. So what I'm going to do is talk through some of them in a little bit of detail, others at very high level, just so that you're aware of them, more for completeness of your knowledge. If anybody believes that any of them have a huge, massive impact, more than happy to take a question. Otherwise, if you want to have a chat with Graham after the session in your specific scenario. So the ones I've got asterisks next to are the ones that I am going to talk about in a bit more detail. So hence I'm not going to talk through them on this overall slide. The first 2 that I will talk about, 1059 and AIASB 2019-7, are both public sector standards. So just again, for completeness of information for you, 1059 is where the public sector is issuing a service concession arrangement. So think something like a toll road, where they're getting the private sector to build, operate and maintain a road for them. That's a service concession arrangement generally. And what this standard does is give some guidance for the government in how to account for those particular arrangements. There's guidance for the private sector through the IFRS standards, but there's never been anything for the public sector in Australia. So that's what that standard does. 2019-7 is purely at a whole of government level. So at whole of government, our governments have to report on something called Government Finance Statistics, or GFS. And that's something that they report to the Bureau of Statistics that gets reported internationally and is one of the benchmarks used to compare performance of a country. All this standard does is to say where there is a difference between GFS and GAAP, there is some relief from certain reconciliations that need to be disclosed within the financial statements. The next one is the conceptual framework. So for those of you who may be currently studying or may have studied recently or may have studied a significant time ago, you would remember that there is a document called the conceptual framework, something along those lines. It's the umbrella document that deals with definitions of assets, liabilities, income, expenses. It's the document that makes sure that as standard setters, we try to give some cohesion to our accounting standards because they're all operating under that same umbrella. You guys would use this document if, for example, you've undertaken a particular transaction or balance that is not explicitly covered in an accounting standard, because this would help you formulate your relevant accounting policy. Fairly fundamental document, has changed in the year. However, the complexity to this is we are currently running 2 conceptual frameworks within Australia. So this document, the Conceptual Framework for Financial Reporting, is applicable only for for-profit, publicly accountable entities. So effectively, that's your listed, it's your financial institutions, it's anyone else who chooses to give an IFRS compliance statement. So not an Australian accounting standard compliance statement, an IFRS compliance statement. Everybody else is still under the old framework. So that framework is called the Framework for Preparation and Presentation of Financial Statements. So it's just important when you, if you do need to use this document, that you use the right one. The one that's called Conceptual Framework is the new one, only for-profit publicly accountable entities. I don't think there's huge changes between them. I don't expect anybody to have fundamental differences in accounting policies, etc. But the definition of an asset, definition of a liability has been changed. So if you do need to use the document, just please make sure you are using the right document. The next one, IASB 2019-3, is to do with interest rate benchmark reform. It's not an area I know a huge amount about. Try to avoid those financial instrument spaces if I can, but it's to do with the fact that LIBOR has been removed internationally. So if you were doing hedge accounting, so not just hedging, but hedge accounting, and your hedge was linked to LIBOR, the removal of that benchmark has caused your hedge to possibly lose some of its effectiveness. So consequently, all this standard does is to provide some guidance if that has occurred. The next one, 2019-5, is to do with everyone's favourite disclosure, the standards issued, not yet effective disclosure. So what this standard says is if you are giving an IFRS compliance statement, so again, your financial statements comply with IFRS, not just Australian accounting standards, then it reminds entities that they are required to look at all standards that have been issued by the International Board and not just standards that have been issued by the Australian Board. Most of you won't be relevant. However, it does give me a chance to get on my soapbox about that particular disclosure. So let's imagine that instead of this slide being called 30 June 21, I'd called it 30 June 22. And I was sat here telling you about all the standards that were released, but not yet effective. So if we think about that disclosure, for the majority of you, I've said that many of these just aren't relevant. They're just not applicable. You're not within their scope at all. What therefore I wouldn't want to see within your standards issued not yet effective disclosure is a list of all these standards with a full description of what the change in policy is. And then the last sentence says this standard is not relevant to us. If it's not relevant, please don't include it. We're really looking at that disclosure being standards that are applicable to you, that are relevant to you, that may well cause a material impact to your financial statements. So just as I say, that bit's not new. It's just because I was talking about that disclosure gave me an opportunity to go through that. So I am going to come back to the other 3 that I haven't talked about, the definition of a business, definition of material, and our Corvid rent concessions. No burning questions seem to be coming through on the ones I have talked about, so I'll move through onto the next ones. So in relation to a definition of a business, this is a change that could be very relevant if you undertake a transaction that could be impacted. if you don't undertake a transaction, it won't be relevant. So it's one of those things that you need to park at the back of your minds. And if you do undertake a transaction where this could become relevant, it needs to pop to the front of your mind, or at least remember that something's changed. So the change in the standard is all about what is a business versus what isn't a business. So it's really crucial to understand if we're acquiring a group of assets, are we acquiring just a couple of assets, in which case we recognize them under the asset accounting standards, generally property, plant and equipment and intangibles, or is the stuff that we've acquired a business? And if that's the case, we're required to fair value the assets that we've acquired. We're required to look and see whether there is any identifiable intangibles that the seller didn't recognize that we need to. We then compare that with what we paid, and potentially we'll end up with goodwill or a gain on bargain purchase. Very, very different accounting. So consequently, it's really important to understand if we've acquired a business or not. So let's look at what's changed. The definition has changed. It's very much now about thinking of the market participants. So what would a reasonable person expect to do, not what you intend to do as the buyer or the seller. It's all about those imaginary market participants that we've got. The updated definition is there. I'm not going to read it to you. You can all read as well as I can. You can see that the parts that are crossed out are the bits that no longer exist. The parts that are underlined are the new bits. So it's all about, have we got inputs? Have we got activities that are capable of being run as a business? Outputs is not a necessity. We don't need to have outputs to have a business, but we do need to have our inputs and our activities. So what the standard setters have done is they've introduced what they call an optional concentration test. Now it is optional, completely optional. You can use it on a transaction or not. The intention behind this is to say, if I've acquired a few assets and all the value is in one particular asset that I've got, I've probably just acquired an asset, and I can say I've just done that for ease. And we'll see an example later on around this. So the optional concentration test says, have you acquired one asset or a group of assets that are similar? Is all of the value that you've paid for, all the value that you've acquired, is it in that one asset or that group of similar assets? If the answer is yes, you can conclude that you have not acquired a business. You just recognize all of the assets under the property, plant and equipment standard, for example. If you answer no to any of those questions, you have to consider still whether you've acquired a business by looking at that definition, by thinking about the inputs, the outputs, and the activities. So that concentration test could be very helpful if is applicable. In Australia, I've seen it a fair amount being considered with things like tenement acquisitions, where all the value of what you've acquired is in the tenement. You might have acquired a little bit of property, plant and equipment or plant and machinery, but all the value is in that tenement. So for things like that, it could be quite helpful. So if we then look at the definition of a business and we think about, we've acquired inputs, generally that's pretty much of a given that we've acquired inputs. We need to know whether we've acquired outputs or not, and then we need to determine whether we have acquired the activities that can turn the inputs into the outputs, so that are capable of doing that. So what this definition does is it separates the different components into whether what you've acquired currently does have outputs or not. So let's look at the right-hand side of the slide first. We know we've got inputs, we know we've got outputs. We need to work out whether we've acquired those activities in the middle. So the standard tells us that we're looking to see whether we've acquired a substantive process. And a process is substantive if we have outputs, if either it's critical to continue producing the outputs, or it provides significant contribution to be able to turn the inputs to outputs. And if we were going to replace it, it would be fairly costly. So we're looking at things like process manuals, procedures manuals, IP, that type of thing that to turn this into whatever this looks like. So our inputs into our outputs. So that's if we do have outputs. What if we don't? What if the thing we've acquired doesn't have any outputs? The rules change slightly. So it says, okay, when we're looking for our process, we need to have two legs to this process. The first leg is we need to have acquired something that, again, is critical to turn the inputs into the outputs, such as my process manual, such as my IP, my patents, whatever it happens to be. and I have to have acquired an organised workforce. Now, this is the first time within the standards that we recognise that really a workforce is really crucial to being able to do things. Still can't recognise them as an asset on our balance sheet, but we have to have acquired a workforce if our operations do not currently, or if the thing we've acquired does not currently have outputs. So the change gives us that optional concentration test, but also gives us different rules depending on whether we have or have not got outputs. So let's look at an example to try and bring that into a little bit of context. So I've gone out there and I've undertaken an acquisition. I've acquired land and buildings with a fair value of 3 million. I've acquired employees, and I've acquired some standalone equipment with a fair value of 2.9 million. Now, I deliberately wrote this standard in a certain way, which we'll see when we consider the fair values. I didn't acquire anything else. I didn't acquire any processes, didn't acquire any IP. And at the time of my acquisition, the facility was not producing, so it didn't have any outputs. So for whatever reason, really just to illustrate how it works, I decided I would use the optional concentration test. Now, realistically, in this scenario, I wouldn't, because I know what the outcome is going to be. I acquired land and buildings, and I acquired equipment. They're two separate type of assets. We can't lump them together and say they're similar. So therefore, we have to consider them separately. And if we look at the fair values of both of them, the fair values of them are pretty similar. So I deliberately wrote the example to fail the concentration test. If my equipment was worth $100,000 and my land and buildings was worth 3, probably I would have passed it and said that really what I've acquired is land and buildings. So because I failed the concentration test, I then have to look at the other components. So I don't have any output, so I have to consider whether I've acquired an organised workforce, which I have, yes. Have I acquired the thing that will allow me to turn my inputs into my outputs, however? No, I haven't, because all I've got is plant and equipment, land and buildings. So consequently, I failed that and therefore have not acquired a business. I would just recognise my land and buildings and recognise my equipment. This is still going to be judgmental. Quite possibly it removes some of the judgment that we used to have, but it's still going to be judgmental. And I think we will end up with some quite different answers from what we used to have under the old definition. So as I said at the start, when I started talking about this particular standard, it's really about it kicks in if you acquire some things. So if you're even planning on making any acquisitions, it's always worth just thinking about this, because very, very different accounting outputs, whether you've got a business or whether you have just acquired an asset. All right, let's move away from definition of a business and we'll think about materiality. Definition of materiality has changed, and this is part of the International Board's project to really try and make financial statements more meaningful, more understandable, more plain English, under the illusion that maybe someone will pick up the financial statements and be able to read them. So what they've done is they've altered the definition of materiality. Now, remember, this is in an accounting standard, and the accounting standards are written for preparers. So this is a definition for you. Your auditors still have a definition of materiality, but that's in the auditing standards. This is focused on the preparers. Now, in my words, rather than the standard words, what it says is get the rubbish out of the financials. Just because you have really long set of financial statements doesn't mean they're good, because what you've probably got is lots of stuff in there that's completely irrelevant. The words in the standard are a little bit nicer than my words, and it says that if you obscure material information with immaterial information, then that impacts your assessment of materiality. So again, don't put lots of information in there, because what you're doing is hiding the really important stuff. And when I go through financials, most of the time what I'm doing is crossing things out, because we've got things in there that just don't add any value to the user. So everything in there should be important, should be meaningful, should be useful, and should actually give them information to help make their decisions, rather than things like cash note's a great example. We have cash on the balance sheet, and then you have a cash note that has one line item that says cash at bank, which is exactly the same figures on the balance sheet. What are you adding to that? Nothing. You're just adding clutter within the financial statements. So I would encourage you all to have a think about your financials, have a read of them, ideally pre-year end when you're starting to roll them over, And just think, have we got lots of information here that is obscuring the important information? Next standard I just want to cover off on is the COVID-19 rent concessions. We did talk about this last year. It's a standard that was released by the International Board on very short notice when they realised how many concessions were being given out in relation to COVID. Now, again, in my words, not their words, modifications within the standards, lease modifications, are incredibly complex, which we'll see in the next section when we talk about that. So because of the prevalence of all these modifications, the International Board wanted to give some concessions to entities to say, rather than going through the pain of modifications, we'll allow you to make it a little bit easier. And they said that if you have received a concession due to COVID and it meets 3 criteria, we will allow you to treat the concession like a variable lease payment. So effectively, just put it through the P&L. So if I've let you off rent for the next 3 months, you can take that as a credit through your income statement because it's income that you've received effectively, rather than having to go through and recalculate everything. The change from this year compared to last year is in that bullet point B. That used to say 30 June 21. COVID unfortunately hasn't gone away. Those of you who don't remember from last year, I'm in Melbourne. We're still in lockdown, or we've been out, but we're now back in it. So COVID definitely hasn't gone away if you are in Melbourne. But what they've done is extended that time frame. So it now covers all payments that were due on or before 30 June 22. Now, I have had lots of questions on this with people who've been looking at this. If anything else changes in the lease, you are not covered by this expedient. It is purely where you've either been let off rent or the rent has been deferred. So it's all to do with the amount that you're paying. It doesn't count if you've decided to drop the amount of space that you want or you've decided to end the lease early. So that's that bullet point C there. It is only if it affects the amount of rent that you are paying. Makes life much easier if you use this expedient because it's just a P&L impact rather than a full recalculation. This relief is not available for lessors. It is only available for lessees. So just to be aware of that. I imagine most of you listening are in the lessee space, but if you do have any subleases, as a lessor, you are not provided this particular relief. So they're the new standards in place for 30 June 21. What I want to cover off now is just some other things that I thought would be really useful for you to be aware of. This is a standard that has been released, or it's an amendment to a standard. It actually amends AASB 101, our presentation standard. I don't know very many paragraph numbers within the standard because I don't need to. I know the content, I don't need to know the numbers. I do, however, know paragraph 69D of AASB 101 because it is a paragraph I get asked lots of questions about. So this is about whether you classify a liability as current or non-current. Prior to the release of this amendment to the standard, we did used to have that term in there to say whether you have an unconditional right to defer settlement. The standard setters a while ago proposed to remove that word unconditional, and everybody got really excited and they said, fantastic, all those loans you've been making us put as current can be classified as non-current. They can't, nothing's changed. Well, the reason the International Board removed the word unconditional is because they said nothing's unconditional. So if I have a bank loan and it says, if I breach, bank can call on it, that's not unconditional. So they removed it just to remove confusion. So consequently, we weren't really expecting anything to change. However, when the standard was issued, paragraph 72A was slipped into the standard. Now, this paragraph was never exposed within the standard itself. When it came out, people were a bit concerned about what the implications were, and some questions were raised to the International Interpretations Committee. The International Interpretations Committee have put out some examples, and they have now gone back and said, we agree with our decision, but we're going to go back to the International Board on this because it's causing so much confusion. Now, this standard is not effective until 1st of January 2023, which is 30 June 24. But I just want to talk through an example for you, just so you understand what this standard could mean. So if you've got pen and paper in front of you, you might want to write down what I'm saying. If not, I'm not going to say that much to remember it. I'm an entity with a year end of 30 June. We'll assume it's 30 June 24 because that's when this standard kicks in. So at 30 June 24, I have a bank covenant, and that bank covenant tells me that I am required to have a current ratio of 1. I look at the bank covenant, I look at my actual current ratio, and my actual current ratio is 1.1. Fantastic. I exceed my bank covenant, all good. However, I then look out the next 12 months and say, okay, what else does my bank covenant say? My bank covenant says that at 31 December 2024, my current ratio has to be 1.2. We've talked about it internally. We're comfortable that we're going to reach 1.2, not a problem at all. However, what paragraph 72A says is at the reporting date, if you have a covenant that will be tested in a future 12-month period, and at reporting date you do not meet that covenant, you are required to classify the whole loan as current. So in my example, my current ratio at the moment, my actual, is 1.1. In 6 months' time, it needs to be 1.2. 6 months' time is less than 12 months. So because I don't meet that at the reporting date, that whole loan is classified as current. Now, this is potentially an issue if you have escalating covenants. Just something to be aware of. As I say, the standard is not yet in. So effective 31 December 23, 30 June 24. At this point, I don't know what's happening. The International Interpretations Committee have agreed that that example that I've just given you is valid. It's taken from one of their examples. Whether the International Board will change their mind or not, I don't know. But if you are negotiating bank covenants and you do have any of those escalating covenants, just be aware that any covenant you do not meet within the 12 months after the reporting period will cause the loan to be classified as current, regardless of whether you believe that you will meet it at the time it will be assessed. So just wanted to raise that one with you because it is something that I am concerned could cause some huge issues in the next few years. All right, next element I just want to talk about is for the not-for-profits who are listening, those not-for-profits who are ACNC registered. The ACNC has put out some best practice disclosure guidance. It's best practice, it's not mandatory, it's not in a standard. However, what they often do is they put it out as best practice and then mandate it if nobody takes it up. If they will mandate it, however, it is likely to be mandated in the annual information statement, not necessarily the financial statements. So I just wanted again to raise your awareness of this, the 3 different elements of the disclosure that they're looking at. The first is where you have more than 10% of your funding coming from government sources. And that's whether it's government grants, that's whether it's government assistance, that's whether the government is just one of your normal customers, for want of a better word, in the not-for-profit space. Then they would like you to disclose separately the amount of revenue that you earn from the government. They would like you to split that into the amount that you earn from state, federal, and local government levels. And they would like you to name the top 10 sources of government. So, for example, if you receive money from the Federal Department of Health, you name them. If you receive money from the State Department of Education, now you're probably not going to get them from the 2, you name them. If you receive money from the local council, you name them. So that's a disclosure. There is some example disclosures in the ACNC paper that they put out, but principally that's what it stands for. The next one is they would like you to disclose your economic dependency on government revenue. And the way that they've described that is they've said if your programs or services would decline significantly if you did not have the government funding, they believe you are economically dependent. If the amount of funding that you are receiving is likely to expire within the next 12 months, they also want that disclosure. And what they would like is for you to state that you are economically dependent and why or how, and what is management's assessment of whether that government funding will continue. So that's a real judgment call around that particular assessment. Remember that these aren't mandatory, they are best practice at this point. The third component is where you have received funding from government, but you have not yet recognised it as revenue, because If you were complying with the standard, it would mean you were in IASB 15, you've recognised it as a contract liability. That's the disclosure that they want. They have acknowledged that if you were complying with IASB 15, you would show this disclosure anyway. However, if you are not complying, they would like a disclosure of funding that you have received that has not yet been recognised as revenue. I would also, in that case, make sure you make it quite clear that you have not complied with IASB 15, because the numbers will be quite different whether you have or whether you haven't complied. Because if you aren't complying with the standards, you are probably deferring all of your revenue until you can match it with expenses. If you are complying with 15 and 1058, there's probably a much lower level of revenue that you can defer. Also slotted into that one, they have said that they would encourage entities to disclose cash flows received from government sources on the statement of cash flows. So they're available. Pick and choose which ones you want to put in, include them all. They are just the best practice. The next thing I just wanted to cover off very briefly is just a reminder that at 30 June 21, we would still expect to see a COVID disclosure in every set of financial statements. And that disclosure should be about the story. Think about the relevant story for you. Tell me what's happened. If we were having a conversation and I said to you, so has COVID affected your business over the last 12 months and what do you expect to see going forward? That's the story I want to see within your financial statements. So tell me any key assumptions you've made around capacity, around opening hours. If you are operating overseas, tell me what the impact over there has been. What's changed? Don't blame COVID for everything, because we don't know what would have happened if COVID hadn't been there. So we've got to be very careful about trying to show what things would have looked like had COVID not happened. And if things would have happened anyway, don't blame them on COVID. So very much a factual disclosure. I don't expect to see a disclosure that says we don't know, COVID's around, it's been around, we've got no idea, because we do. We know much more than we did last year. So I would expect to see much more of an explicit disclosure in the financials for this year. If anyone's listening thinking, well, it's had no impact on us at all, I would expect to see that too. And ordinarily I wouldn't have said that. But because all users are really expecting to see a COVID disclosure, I think if you don't put it in there, entities won't make the assumption, or users won't make the assumption that you didn't have an impact. They will make the assumption that you've forgotten to put the disclosure in. So I would cover that off regardless. And that's why I say that I would expect every set of financials to include something around that. Graham, that's it that I wanted to talk about on the new standards and the new pronouncement. So any questions that might have come through at all on those, happy to take.
Yeah, thanks, Carmen. There hasn't been any questions that I can see have come through on that first part of the presentation. If anyone has any, please use the Q&A box. I'll just give that a few seconds. Otherwise, Carmen, I'll let you proceed to the next section of your presentation.
Can't see anything been appearing, so I'll continue. And as I mentioned, we will leave some time for Q&A at the end.
Thanks,
all right.
Carmen.
So we'll move now on to looking at year 2 of leases. So I didn't want to go back to basics and tell you about the leasing standard. What I really wanted to do is say what's different this year. What do you really need to think about this year? So let's look at the different things that might change within a lease. So we're talking first of all about our variable lease payments. So there are 3 ways that a payment might look variable within a lease. 2 of them are actual variable payments. The third one isn't. First one is where something changes due to a change in a rate or an index. Probably 90% of leases that I've seen have had some sort of CPI change or have had a market rent reset at some point within the lease. So those changes will mean that the amount that we pay under our lease will change, and therefore our lease liability will change, potentially annually. So how do we deal with our CPI changes? We can't guess what CPI is going to be. We've got absolutely no idea. So what the standard says is, it says rather than guess, you just assume that what you pay today, you will pay for the life of the lease in your lease liability calculation. Next year, when we know CPI changes and our lease payments change, let's say it's moved from 100 to 103, we then assume that we will pay 103 for the life of the lease. Following year, it goes up to 105. We recalculate again, assuming it will be 105 for the life of the lease. So that means every year you are altering your lease liability, your right of use asset, because that's the other side of the entry, your depreciation and your interest. It's painful enough for one lease. If we think about the fact that most of you would have multiple leases in place, and I can guarantee that they will not all have the same anniversary date. So therefore, throughout the year, we need to be thinking about these changes and making sure we've tracked them. Is it material? $10 million question. If you've got long leases and you've got multiple leases, quite probably yes. And the only way you know whether it's material or not is to calculate it. If you've already gone through and calculated it, you might as well just book it because it's not that hard an adjustment. But we can't assume that it won't be material, as I say, particularly where you have long leases or multiple leases in place. The second one is where we've got variability due to sales or usage. So the common ones are the photocopier, where we pay price per photocopy, the car, where we pay the price per kilometre. Those variable payments, again, we can't estimate. We're not expected to guess how many kilometres we might drive, how many photocopies we might make. So what we do is if there is a baseline, a floor, so with my photocopier, I pay $200 a month plus 1 cent for every copy that I make, that $200 a month gets recognised in my lease liability. The 1 cent per copy that I make gets recognised through the P&L as and when incurred. So I've had a few questions during the year where entities have got themselves in a bit of a muddle because they've tried to estimate how many desks they're going to use in a workspace where they pay per desk. And how did they deal with the change between the actual desk and the estimated? You deal with the change by getting rid of it from the lease liability and the right of use. So we've had some fairly big adjustments occurring. So where it's variable due to sales or usage, it does not get recognised in the lease liability. It does not get recognised in the right of use asset. It purely gets put through the income statement. You still have a lease. You're still within AASB 16. It's just that the accounting is different. The third one is where something is structured to look variable, but it really isn't. So for example, if I give you, we enter into a lease arrangement, and that arrangement says that you only need to pay me when the asset I give you works. If I give you an asset that doesn't work, you aren't going to sit there and go, fantastic, this is great, I don't need to pay Carmen. You're going to ask me for an asset that does work because that's why we've entered into the agreement. So even though it might be structured to look as if it is variable, it's not. It's very much a fixed lease in place. So I imagine the vast majority of you will have at least one of those first two variable payments that are occurring in most of your leases that we've got. So think about that and how you're going to track those. What else might change? So we might have some other changes to our leases, particularly over the last 12 months and going forward. I wonder if we will ever see 100% of people in the office 100% of the time anymore. We're seeing much more hybrid type working arrangements, which is meaning that entities are saying, well, hold on, do I need all of this space I've really got that I'm paying quite a significant sum of money for? Can I drop the amount of space I've got where I thought that I was going to renew a particular option? Am I going to now? So all of those are changes that will occur to the lease. What we have to do with any change that's happened is determine whether it is a lease modification or a lease reassessment. Now, this is a complication that is in the standard. To be honest, I'm not sure why it has been separated out. We're seeing that entities are really struggling with what the difference is, but again, quite different accounting depending on what my answer is. A lease reassessment is where there was an option within the standard and within the lease, and either you've changed your mind. So for example, we had a 5 + 5 + 5 lease and we thought we were going to renew it for the first option. We thought we were going to stay there for 10 years, probably not now. So you've changed your mind. It's something like CPI, where we were waiting for information. It's something where we had, as I say, various options to reduce the space, and we've decided to exercise that option, so not just the lease term. So what we have to do, first of all, is determine whether we need to use a new discount rate, and we'll look at that at the next slide. But otherwise, with a reassessment, we just alter the difference in the lease liability, the difference in the right of use asset. Right of use asset is a balancing figure, effectively. If it's a modification, that means that there is a change to the terms and conditions of the lease that we were not expecting. So for example, I only had a fixed term of 5 years for my lease, and I've now decided that I would really quite like to extend that. I would really like to go for 7 years. That wasn't anticipated on day one of the lease, and therefore I didn't have that option in the lease. It's a modification. I was leasing 4 floors of a building. I now only want to lease 3 floors. Given that CBDs are quieter, I've managed to renegotiate a better deal on my lease. That's a modification. So we'll look at how we account for those in 2 slides time, I think. So we have to understand whether it's a modification or whether it's a reassessment. And we'll see an example a little bit later where we contrast the two. So regardless of whether you've got a modification or a reassessment, you have to make a decision about whether the discount rate needs to change. Ordinarily, we do not change the discount rates in leases. So they stay the same, whatever we set them at day one stays the same until something changes within the lease. So as you can see from the slide, if I go on to the right-hand side, if my change is due to CPI, for example, I just use the original discount rate. I don't have to change that. If, however, I've changed the lease term, I need to use an updated discount rate that reflects the current conditions that we've got. Probably going to be an incremental borrowing rate because it's unlikely the implicit interest rate in the lease, if you have it, would change. So we know whether we change the discount rate. Then we move on to our modifications and we say, okay, let's have a think about modifications and how we deal with them. If I've got, and this is where I'll work through some of the examples, as I've already mentioned, if I've got a reassessment, all I do is change the lease liability and change the corresponding right of use asset as a balancing figure. If I start at the left-hand side of this slide, I decide that I'm going to go from 3 floors up to 4 floors. So I've got an extra floor, I've got an extra right of use asset. The question that I have to answer is that fourth floor, is that at its standalone price? So could the person in the street come in and say, I'd like to lease a floor, please? And they would have charged that person off the street exactly the same price as what they charged me. If the answer to that is yes, then effectively it's a separate lease because it's what any random could have got. If I answer no to that, no, I got a great discount because I was an existing tenant and I'm an amazing tenant and was really quite a significant discount. Then what I have to do is I have to alter the existing lease liability and the existing right of use asset that I've got. As you can see, it kicks me into a revised discount rate. If I now go to the far right-hand side of the slide, I had 4 floors and I now want to drop to 3. What I'm doing is effectively disposing of an asset. So if it's a modification, if it was not something that I was expecting to happen or I didn't have an option for this to happen, I revise the discount rate again, but I treat it as a disposal of assets. So I say, well, okay, I've got rid of effectively a quarter of my asset. I have to recalculate the lease liability. I do all that, first of all, using the same discount rate. And any difference between my drop in lease liability and my drop in right of use asset will be taken to the income statement as a gain or loss on modification. So we actually have a P&L impact. Then I recalculate again using a new discount rate. And any difference between that is a balancing figure to right of use. These calculations are really quite painful. They're not easy to work through. They're not easy to do at all. If we're in that middle bit, that's where we've got any other change other than scope. So for example, it could be the lease term has changed. It could be I've managed to renegotiate a better price. And you can see I remeasure my existing lease liability and I remeasure my existing right of use. Not any change between that middle bit and a reassessment. The other two on the outside, there are some quite significant changes potentially, particularly with a disposal compared to a modification or a reassessment. So I wanted you to think about, how are you recording your leases? What system have you got in place? Are you using Excel for this, or have you actually purchased a system? Couple of scenarios to just throw out there for you. So I've had a number of clients who have used Excel and have realized that whilst Excel is a great number cruncher, it can only crunch what you tell it to crunch. So unless you understand whether you need to change the discount rate, whether I should be going down the left-hand side of my flowchart, whether I should be going down the right-hand side, whether it's a modification, whether it's a reassessment, Excel can't give you the right figures. So it's really making sure that do we understand, if we are using Excel, how we are going to get the right information in there. I've had another clients who are using some relatively expensive lease systems in some cases. And they've said, well, we assume our system can do it. We just don't know how to tell the system what's changed. So we've had a number of changes in the year, but how do we tell the system what's occurred? So in those instances, those entities have actually had to go back to the system provider and get some training about how to work with their system, given the particular scenarios they've changed. So just because we got this right last year, we got our opening balance sheet, we managed to get our way through year one of leases, we really need to be thinking about how are you tracking these changes for year two? What system are you using? Do you know it's working? Is it doing what you expect it to do? And who is tracking these changes? Because I expect the vast majority of you are finance teams. You're not necessarily tracking these leases and understanding the changes. So what communication is happening between the people who are managing your leases and you guys to make sure that we're up to date with all of these calculations and we've got a system in place going forward. Graham, that's all I had to talk about in relation to leases, unless we've got any questions or you've got any comments at all.
Does anyone have any questions for Carmen on leases? I think from the audit standpoint, one of the key things around AASB 16, it's not a set and forget standard, as Carmen's outlined. Lease terms do change during the course of a lease, particularly with COVID. So if you do have any questions in relation to any change to your lease, feel free to contact your Hall Chadwick point of contact or raise them with Carmen either now or during the next part of the session. Otherwise, I will ask Carmen to go on to the third part of her presentation.
Fantastic. Thanks, Graham. Hopefully everyone's typing away questions because I'm sure there's probably a few on that leasing area. So please feel free to type them in because I would much rather be able to answer them today. So at least you're a little bit more aware of what you have to do. So the next element that I'm going to talk through before we get onto the question and answer session is just to give you more detail around the Australian Financial Reporting Framework. So we did allude very quickly to it last year, but we had lots to talk about last year. So this was kind of just an add-in at the end. So it is receiving huge amount of attention in the press. And therefore, even if you're not impacted, you have probably heard about it. What we're seeing huge confusion around is there's still a lack of understanding about who is impacting, what the impact is going to be. Graham mentioned that I was a former IASB member. I am still doing some work for the IASB, and we've recently run some webinars around this particular topic. And the questions that we are being asked really show that there is still significant confusion around this. So hopefully we can address some of those. And again, any questions, no matter how silly you think they are, I'm not going to name names, so you can put them in anonymously and we can hopefully answer those to make sure everyone understands where we are. So let's start off with looking at who is impacted. We talk about these changes to the reporting framework. Let's look at who's actually impacted. So if we do the public sector, first of all, unless you're doing RDR, you're not impacted. Very easy. Let's jump now to the not-for-profit private sector. So those not-for-profits who are listening. Same comment. Unless you are currently doing RDR financial statements, there is no impact on you at all. So just to clarify that, if you are currently preparing special purpose financial statements as a not-for-profit entity, you can continue to do that. There is no impact for you. The only impact is for RDR entities in the not-for-profit space. The third column, or fourth column of my table, but the third element of it is the for-profit private sector. And they're the ones who are principally going to be impacted by the changes to this standard. If you are doing RDR, you are impacted, and we'll talk about that next. If you are doing full IFRS Tier 1, you are not impacted. I imagine you are going to continue to use that. If, however, you are doing special purpose financial statements, the reason that it is a question mark and not a yes, you are going to be impacted, is because it depends what type of for-profit entity you are. What we're going to do is look at what general purpose look like, and then we're going to come back to who will have to move to general purpose. Your impact is going to depend on whether you currently comply with recognition and measurement, and by that as well, I'm including consolidation and equity accounting. So if you are a for-profit who is required to move to general purpose financial statements and you are not currently complying with recognition, measurement, consolidation and equity accounting, you are going to have the most impact, hence my circle on that slide. So that's the who. We'll keep coming back to that and throughout the session. So let's look at what general purpose financial statements will look like and why those RDR entities are going to be impacted. So we currently have two tiers of financial reporting within Australia. We have our Tier 1, which is our full IFRS. We have our Tier 2, which used to be reduced disclosure requirements, used to be RDR. And the way that we would identify our disclosures is we'd look through every standard and we'd look for the shading. And if it was shaded, that meant you didn't have to do it if you were doing RDR standards. It was a bit painful to do that, it has to be said. The way that RDR was developed, therefore, was to take the whole standards and to reduce the level of disclosure, and that's where its name came from. The new Tier 2 is a simplified disclosure standard. So all disclosures are now in one standard, AASB 1060. So the way that this Tier 2 will work is that we look at all the recognition and measurement from all of the other relevant accounting standards. We do consolidation and equity accounting from the relevant accounting standards. But as soon as we hit the presentation or disclosure sections of those standards, we jump out of that standard and we jump into 1060. I'm just looking because I generally have it on my desk, but I can't easily see it. 1060 is all of our presentation and disclosure requirements. Those disclosures were based on IFRS for SME. So that's an international standard that we do not use in Australia. However, the Australian board believed that it was a really great starting point to develop our disclosures. So consequently, whilst RDR was a top-down, SDS is a bottom-up. So we've taken IFRS for SMEs as our baseline. There are a few disclosures that we've added in additionally, where we believed in Australia there were specific reasons to add them back in. One of them being audit fees, because quality of audit in Australia is receiving a bit of attention, and audit fees, it was a recommendation out of the Parliamentary Joint Committee. The other one is imputation credits, so our franking credits effectively. And that's because they don't necessarily exist internationally, and users did tell us that was information they found useful. So they're the two Australian specific things we've put back in. So we still, when we talk general purpose, we're still talking two tiers. Full IFRS, which if you're not already there, I wouldn't expect you to go there, or our Tier 2, which is our simplified disclosure standard. So what if I'm currently doing RDR? If I'm currently doing RDR, I can't do that anymore because from 1st of July 2021, RDR will no longer be maintained, will no longer exist. So therefore, an entity who is currently doing RDR financials will have to move. You will either move to your Tier 1. I don't know why you'd do that if you're already in RDR, but it is an option. Or you'd move to the new Tier 2, which is our simplified disclosure. So your basis for preparation would refer to we comply with Australian accounting standards - simplified disclosures. Now, there are two ways that you can transition from RDR to SDS. You'll be able to tell when I talk which one I think is the preferred. The first saves you lots of time on day one. So what you would do is you would look through AASB 1060, work out where there are disclosures in 1060 that are not currently in your RDR accounts. There are a couple of extra things, and you would add those in. And you would then say, okay, we're done. Because AASB 1060 is always minimum disclosures. You can always go above, you just can't go below. That's the quickest way on day one. It will take you longer going forward because every year you will have extra disclosures in your financial statements, which you do not need. They are just hangovers from the RDR because overall there is less disclosures in the new Tier 2 than there was in the old Tier 2. The alternative approach, therefore, is if you go through and you say, right, what does 1060 require me to disclose? Take out everything that is no longer required and just put in the extra couple of disclosures. That means your financial statements will be much more streamlined, and it means going forward you are preparing the notes that are required only. You're not doing extra notes as just a carryover or a drag on. I think it'll be quite clear which one I think will work. Second one will take longer at first, but it's absolutely much more effective going forward because your financial statements are much more meaningful. And if we come back to that definition of material that we talked about at the start, you're not obscuring material information with more things that you are no longer required to do. So that's an entity moving from RDR to SDS. The only thing that will change is the disclosures, because under RDR, you were already doing general purpose. That meant you were already complying with recognition, measurement, consolidation, and equity accounting. So it's purely just a disclosure change. There's some incentive for early adoption, so you don't need to, for example, disclose audit fees for the prior year. That's it. To me, not a huge reason to early adopt. If you want to, go for your life. If not, you will have to move at 30 June 22. So 30 June year ends go first. All of the year ends come after that. Doesn't look like any questions have come through on that. So we'll now move on to look at which for-profit private sector entities can no longer do general special purpose financial statements. So AASB 2020-2 is the relevant standard that we're looking at. It's called exactly what it tells you. So it's removal of special purpose financials for certain for-profit private sector entities. So who are those for-profit private sector entities? If an entity meets either of those two criteria on the slide, they will have to prepare general purpose financial statements from 1st of July 2021. So let's look at the first one. You are required by legislation to prepare financial statements that comply with Australian accounting standards. So if you are a for-profit private sector entity and you are governed by any legislation that requires preparation of financial statements in accordance with Australian accounting standards or accounting standards, you will have to do general purpose. Let's take the Corps Act because it's the most obvious one that we all think about. So if we think about the entities that are required under the Corps Act to prepare financial statements in accordance with that actually refers to accounting standards, it is all large proprietary companies. It is small foreign-owned proprietary companies. It is small proprietary companies that do crowdsource funding. It is AFSL holders, so Australian Financial Service Licence holders. It is any small proprietary that has got an ASIC direction or a member direction, shareholder direction to prepare financial statements in accordance with accounting standards. So there's some examples of who's included. So any of those entities, it doesn't matter whether you try to argue that you've got users, it doesn't matter that you try to argue that you have got mom and dad are still running them and nobody else picks up their business. It is very clear that if you are required to prepare financial statements in accordance with the Corps Act, you will have to do general purpose financial statements. I'll just pause for a second there just to see if there's any questions or comments on the legislation.
Carmen, someone's asked around grandfathering.
Yep.
I think you might be coming to that, but certainly we do have some clients in that grandfathering space. So I'm not sure if you want to cover that.
Yeah, I will, because the grandfathering I'm going to talk about, I'm guessing, is the different grandfathering from this. There's two grandfatherings. So the question is what if a large company has grandfathering? So I'm assuming by that question you're talking grandfathered under the Corporations Act. So what the Corporations Act says, and if that grandfathering provision exists, it says that if you are grandfathered, you will prepare financial statements as if you were lodging. It's just you don't have to lodge. So the words on my slide say if you are required to prepare financial statements in accordance with legislation, you are general purpose. That means grandfathered companies will be required to do general purpose financial statements, regardless of the fact they are not lodging. The requirement is there to prepare the accounts as if they were. So all grandfathered companies will be general purpose going forward, assuming they meet the large proprietary limited criteria. All right, thank you for clarifying that it was the grandfathering into the Corps Act. Yeah. All right, so that's the legislation. Now, I've talked about the Corps Act. It is not exclusive to the Corps Act. It could be any legislation at all that requires that. The next criteria, and that is it's an or criteria, it's not an and criteria. So you are required by your constituting or other document to prepare financial statements that comply with Australian accounting standards. Now, I know I haven't finished that box. I'll come back to that in a minute. So what could be my constituting or other document? It could be a constitution. It could be a trust deed. It could be a bank agreement, a joint venture agreement, a partnership agreement. It could be anything that has been set up that you as an entity are required to comply with. So I'll just repeat those again. Your constitution, trust deed, partnership agreement, joint venture agreement, bank agreement, anything else that would fall into that level. You'll notice that in the right-hand side box, I refer to comply with Australian accounting standards. In the left box, I comply with Australian accounting standards or accounting standards. That is deliberate. And from a legislation perspective, if it refers to either, you are captured. From the constituting or other document, it only has to refer to Australian accounting standards. So now I'm going to deal with the date that's on the bottom of that. This is my second type of grandfathering, which is different from the grandfathering in the Corps Act. So this is a grandfathering provision that we've included within the standard. So if you have a constituting or other document that requires preparation of financial statements in accordance with Australian accounting standards, your next step is you need to look at when that document was created and when that document was amended. I'm going to do the right-hand side of the slide first. If that document was created after the 1st of July 2021, or has been changed for any reason since that date, and you did not remove that sentence in the black box at the top, you are required to do general purpose financial statements. So after 1st of July 21, any changes, or the document was created after that date and that sentence still remains, general purpose. If the document was created before the 1st of July 2021 and has not been changed in any way since that date, that's the grandfathering provision within IASB 2020-2. And what that says is that you can continue to prepare special purpose financial statements if you would like to. There are going to be some additional disclosures that would have to be included. Now, that standard hasn't yet been released. Its release is imminent, but it is likely to require disclosure around whether you comply with recognition and measurement, whether you comply with consolidation and equity accounting, and where do your accounting policies differ from recognition and measurement if you don't comply with them all. So extra disclosures if you do get to use that grandfathering provision, if your document still includes that particular sentence. So just to go back, we've got the legislation side, or we've got the other constituting or other documents. If you meet either of those criteria, it is not a both, it is an either. Depending on the date that that document was created or amended, depends on whether you are doing general purpose or special purpose. There is no judgment. These are very black and white criteria. Doesn't look like there's any questions. Graham, have you got any comments at all on this one?
No, thanks, Carmen. That was quite clear.
Okay, fantastic. So I've told you that the date is the 1st of July 21, which is 30 June 22. Junes are going for the 1st. So if any of you ones listening who has not got a June year end, it is whatever year end of yours falls after 30 June 22. So you have a choice on when you adopt this. So again, I'm going to use a June for an example. I can either early adopt this standard, which will mean that I'm adopting it at 30 June 21 in 28 days' time. If you choose to early adopt, then there is a huge incentive within the standard. And the standard says if you choose to early adopt, we are not going to require you to restate your comparative year. So if we use my example, 30 June 2020, you've done those accounts, you've signed off the accounts, they're kind of put to bed. For your 30 June 21, all you do is you grab those numbers and you whack them in the comparative column. There's no change to them at all, other than you will put a label in there that says prepared under a special purpose framework. 1st of July 20, you then adopt this standard, and at 1st of July 20, you work out all of the adjustments that you will need to make in order to comply with recognition, measurement, consolidation, and equity accounting. All adjustments at that date go through retained earnings at the 1st of July 20. 30 June 21 comes around, you've been complying for the year, and therefore 30 June 21 reflects recognition, measurement, consolidation, and equity accounting, including all relevant disclosures for that year. So from a comparability perspective, you haven't got any comparability because your current year, your 30 June 21, is general purpose. Your 30 June 20 is whatever your 30 June 20 was. So it could be that it was single entity and now 30 June is 21. It could be that you complied with absolutely no accounting standards at all, and your 30 June 21 is now full compliance with recognition, measurement, consolidation, and equity accounting. So that's the carrot, no need to restate. If you choose not to early adopt, what the standard says is you will then adopt the standard using full retrospective application, which means that you will be required to restate the comparatives. So if we adopt at 30 June 22, you go back to the beginning of the comparative year, which is 1st of July 20. That's your opening balance sheet date. You will notice it is exactly the same opening balance sheet date as if you did early adopt. So at 1st of July 20, you put all of the changes through to your recognition, measurement, consolidation, and equity accounting. All adjustments go to retained earnings as at that date. You will then have your 30 June 21, which are in full compliance with recognition, measurement, consolidation, and equity accounting, so general purpose, and your 30 June 22 will be general purpose. So you have full comparability. Everything's prepared on the same basis. The huge downside is for 30 June 21, you've already prepared those numbers and you've had those numbers audited. They've then got to be re-prepared with extra disclosures and re-audited. So you have complete choice. The standard is not telling you which one to do. ASIC is not telling you which one to do, but one of them is much less work than the other one. If you early adopt, you are not restating comparatives. If you do not early adopt, you are effectively preparing and auditing your 30 June 21 again. So that's twice that is being done. So that's a decision you will need to make fairly quickly if you are going to be impacted by this. If you were doing special purpose and you were already complying with all recognition, measurement, consolidation, and equity accounting, kind of doesn't matter because your numbers won't change. This is really kicks in where you were not complying with all recognition and measurement, or you were not consolidating. And that's where we're seeing that the most issues is where an entity had chosen not to comply with the consolidation standard. So we're now having to do extra consolidations. All right, that was all I had to talk about. So I wanted to leave about 15 minutes at the end for questions or comments that might be coming through. Graham, have we got anything?
Nothing further at this stage, Carmen. I might just take this opportunity to thank you, Carmen, for your presentation. Very detailed and thorough as always. As you alluded to, there is a little bit of break for major new accounting standards this year, which I think both from my client's perspective and from putting my audit hat on is a good thing. But certainly the lease standard requires continual monitoring, and for those companies doing special purpose financial reporting, some decisions need to be made as we approach 30 June. So thank you for that. Does anyone have any questions they wish to ask Carmen?
We do look like we have a hand up. It's very exciting. So Sandeep's got his hand up. I'm hoping he can unmute.
Hello, Carmen, can you hear me?
I can, hello.
Just on the audit report side of things. So if an entity is now first time consolidating, doesn't take the option of early adoption,
Mm-hmm.
and when it does report in 2022 and it had been consolidating, but it was not audited as a consolidated account. So that will create, I guess that will create another level of complication as to you'll have to consider whether opening balances will be qualified or will need to be audited.
Yeah, that's right. And I would expect that if you've already been consolidating, I would expect that audit should probably happen, because I think it's cleaner. It's always easier to avoid a qualification. But yet they will introduce some real complexities around what will happen in certain situations. And even if you do choose to early adopt, you've got potentially a single entity in one year and a consolidated in another, which won't result in a qualification, but the opening balance sheet being that 1st of July 20 will need to be audited. So there are extra requirements, because the opening balance sheet will always need to be audited regardless of whether you early adopt or whether you don't. One of the sessions that we did with the IASB was in conjunction with the Auditing Standards Board, and Anne from the technical director, or deputy technical director of the Auditing Standards Board, did cover a few of those issues off.
Okay. Thank you.
Thanks, Sandeep. Any questions from anyone else? We do still have a number of people online. If you have questions, now is your chance to take advantage of Carmen's time. I can't see anything more coming through, Carmen. So in that case, we might conclude the session a little bit early, if there are no questions coming through. And again, I'd like to thank Carmen for her presentation.
Thanks, Graham.
Thanks, everyone. And look, hopefully you did get certain things out of that presentation, and look forward to chatting to you one-on-one as we move into 30 June year end. All right, goodbye, everyone.
Bye.